Now then, let's get back to Kenya. Specifically, it's a digital lending space. As you heard a few minutes ago, the sector is largely unregulated. But that doesn't mean that you don't have Kenyan adults, millions of them in fact, using these services. The loan sizes are relatively small, between $7 to $50, and at least 8.3% of Kenyan adults have borrowed either from a bank or a non-deposit taking digital lender in 2018. Now, that's according to a joint survey done by Kenya's Central Bank, the Country Statistics Bureau, and FSD. But there's a massive data distortion cloud, really, around this sector. So earlier on, I spoke to Kwame Owino. He's the CEO of the Institute of Economic Affairs here in Kenya. A survey that firm did indicated that, at least at face value, the default rate on digital lenders was lower than that on banks. But Kwame started by explaining why that metric needs a lot closer examination.
They claim that they have some kind, everybody hides behind the fact that we have an algorithm. So they say they have an algorithm that allows them to be able to tell your ability to pay and actually your willingness to pay as well. So that's one. But my thinking as well is that those figures are probably the same. It's only that the way they report, defaults are probably not the same. It's not the same definition in them for them.
Because also for banks, they have to report under IFRS 9. So,
yes, precisely.
So if the loan is impaired within, say, 30 days, you have to report.
You have to report that, precisely. Right. So I think that's why. So bank reports and the criteria that they apply, in my view, is probably more stringent, and that allows for that spread.
What about because the thing about this industry, it's not regulated. There's no single pool of information that we can all go to and say, okay, this is what the sector looks like. So, given the fact that it's a mix of regulated entities and non-regulated entities who don't take deposits, what's the data gap in this study? What do we not know?
Yes, I think what we don't know is first the default rates to begin with, whether we are measuring in the same way. I suspect we are not measuring it in the same way, because when banking institutions tell you about default, they are probably applying a different thing. And when these other guys tell you about defaults, they also might be applying a different thing altogether. So that's a first. And then quantum. One other thing that we don't know, because people know that I think many of these, I was at a discussion yesterday when they said that 7.5 million Kenyans actually, or 7.5 million loans have been provided by the non-conventional lenders who use apps. They're not banking institutions, but you're not sure whether that's discrete accounts or whether it's actually the same people having three or
people
four.
might actually have, and I think that's one of the things that came up in the study, because what people tend to do is, I'll borrow from this guy,
precisely,
and then borrow from this other app to pay off this guy.
Precisely, yeah.
And
so
then it just keeps rolling on.
So you're not too sure how many people have multiple accounts or multiple liabilities with each one of them.
The central bank governor, when we spoke to him about this topic in March, when we met in Kigali, he described the lending practices in this market segment in some extent as predatory.
Yes.
I believe we went as far as describing them as Shylocks in one instance. And he's pretty much maintained that line of argument, because his argument is that if you look at the total cost of any such facility, it's pretty high. It's at least in the triple digits in terms of APR. Do you agree with that sentiment?
Well, let's go back to Shylocks. It is possible that actually, the reason I think the governor should be smiling, in my view, is that if these digital lending apps, whether bank-led or those that are provided through other services, come in, then basically what it means is that they might actually shrink out, or rather they might actually wipe out the Shylocks, which is not any formal system and all that. So it's not necessarily a bad thing. So I think having his nose high in the air against them is a bit unfair, in my view. So that's the first thing. The second thing is these guys are just putting their own capital. They're not taking in any deposits, at least so far. So if they're not taking any deposits, they're taking huge risks. And thirdly, asking them to compare themselves to banks, I think we are not comparing like for like. It's clear. Why? Because most of these people actually rely on very little data. They have to be very, very keen. The ability to collect and the contractual systems are also very different. But the most important thing is they're taking a huge leap of faith, because the decision is made almost instantaneously. Yeah. In many cases, they make that decision very, very quickly. They also calculate how much it is. But thirdly, most of their sums are very small. So for instance, if you're lending 500 shillings to somebody who wants to use it to repair something, to repair a gadget, I don't think you should go through all those formal channels like a conventional bank will ask you to fill forms, go all the way, ask you to bring in your pay sheet, your pay slips and everything else. So their fixed costs relative to the loans that they give are very high. So when you compare those, I think we need to be a little more cautious comparing APRs on one side with these other.
But what about the data side of it? Because at the heart of all of this is the fact that these individuals are basically lending to you and they're gathering an enormous amount of information about your life, your contacts, who you're most commonly in touch with, how often are you in touch with them, who are the people in your circles of influence and that sort of thing. And in this country, we both know there's very little in the way of legal protection or determination on how that data can be used, who should hold it, for how long, and for what purpose they can hold it. So in as much as we agree, yes, they do not have to have a banking-like regulatory approach. What about the data side?
Well, I think the data side is something that's not only for the purposes of banking and digital. We need data protection laws, which covers for the fact that, yes, in the course of commerce today, people acquire a lot of information about you, and how they use that information should actually have there should be principles for how that information is used, and it should be used specifically for the purposes, declaration. So for instance, to declare to me, if I go into a building and I sign up, to declare to me that we might one day call you, or after 90 days we are going to destroy this, or to give me the assurance that we are not going to share your data. I just needed to sign in to come to this building, right? So that should be data protection irrespective of what business is, and I think some consumer protection is required around that. I think the most egregious examples are some of these unscrupulous lenders who actually start to go through your address book and call your mom and tell him, look, this guy owes us money for 2 weeks and he hasn't been
actually send messages
and send messages to your friends and everything. I don't think that's acceptable. So obviously drawing that kind of data protection and obviously consumer protection, and actually asking for consent before any of that information is used for other things, supersedes, or rather goes beyond just for the purposes of lending. It's every kind of person who collects data in their legitimate business, and they should have some boundaries about how that data can be used outside their business or who it can be shared with.